There's a version of this idea that sounds brilliant on paper. Every time a company goes public, doesn't matter who, doesn't matter what they do, you put in $1, just one. Equal weight, no judgment, no research. You just show up to every IPO like it's a buffet and take one of everything. Since 2000, that would have meant buying into roughly 600-800 companies. Some of them you've heard of, most of them you haven't, and a handful of them no longer exist. So what happens to your money? The first thing to understand is what an IPO actually is, and more importantly, what it isn't. Most people assume that a company going public is a sign of success. A graduation moment. The business has made it. But going public is really just a liquidity event. The founders and early investors want a way to eventually cash out. The bankers need a deal to close. The company needs capital. And the story that gets told to the public? That's marketing. The business going public doesn't need to be profitable. It doesn't need to be mature, it just needs to be sellable. Which is why the first $1 you would have spent, sometime in early 2000, would have gone into companies that were burning cash faster than they were making it, operating on the logic that revenue didn't matter as long as growth charts pointed up. A lot of those companies were gone within a year. One of them shut down 9 months after its IPO, having generated under $1 million in revenue against an $11 million advertising budget. The sock puppet was memorable, the business model was not. That was .com peak. And if your portfolio started there, it started in a hole. But here's where it gets more interesting. After the carnage settles, the 2000s keep producing IPOs, some boring, some not, and a few that in hindsight look almost unfairly cheap. Google goes public in 2004 at $85 a share. The investment banks thought they were getting a good deal. Google thought it was worth more. Both sides were wrong in the same direction. It was worth far more than either of them priced it. That $85 is worth a multiple of thousands today after splits. If your equal weight strategy bought one share of Google and hundreds of forgettable companies the same year, Google quietly starts compensating for a lot of damage. This is the real mechanism behind the thought experiment. IPO portfolios, when studied, have generally underperformed the broader market over the long run. Source needed for precise figures, but multiple studies, including research by dimensional fund advisors, suggest IPOs have trailed indices like the Russell 3000 in most extended periods post-2000. The reason isn't complicated. Most IPOs are small companies, priced at peak optimism, with uncertain futures. The ones that go sideways or disappear drag the average down hard. The ones that become Google or Nvidia don't fully compensate, because you only owned an equal $1 of each. There's a term for what the winners do in this kind of portfolio. They carry the losers. But the math is lopsided. A company that falls 90% costs you 90 cents on your dollar. A company that rises 500% gives you $5 back. The problem is that the failures outnumber the big winners by a lot. 4 out of 5 IPOs in some studied periods have underperformed small cap indexes. And of the ones that underperform, a meaningful chunk underperform badly enough to leave almost nothing behind. So the honest answer to this thought experiment isn't you'd be rich, and it isn't you'd be broke. It depends enormously on which years you started, how long you held, and whether your portfolio was lucky enough to capture a Google or a Salesforce or Nvidia, early enough to offset the pile of companies you've already forgotten existed. The contrarian part of this is what the question reveals about IPO excitement in general. Every few years, 2000, 2021, the IPO market heats up dramatically. Hundreds of companies rush to go public. Prices surge. And historically, that surge has often coincided with the worst subsequent returns, not the best. A hot IPO market isn't a signal to buy everything. It's closer to a signal to be careful. The companies that changed everything mostly didn't need the hype. They just needed time. So if this experiment tells you anything useful, it's this. The IPO isn't the opportunity. It's often the moment that opportunity gets most expensively priced. The investors who built real wealth from Google didn't buy because of the IPO excitement. They bought because the business made sense, and then they waited. The next time an IPO gets loud, that's probably the right moment to get quiet.